we are here to help military families answer some of their most burning questions about taxes, specifically related to home ownership and military life. So today we have Phil Johnny, the founder and CEO of GoVA. Thanks so much for joining us, Phil.
Absolutely. It's good to be here. I'm excited to talk to our audience and provide some tax strategies and tips and things to keep track of when it's this most important time of tax season.
Absolutely. Now, I know that buying a home is one of the largest and most intimidating purchases, and it can really influence a lot of things in military life. So, can you talk specifically to people who have purchased a home recently? How does that mortgage and those mortgage payments factor into your tax documents?
Great question. So before we get into that, there's two types of, I just want to educate our audience on some tax strategies or some tax 101 basics, right? And so when we look at doing our income taxes, we know that we have our gross monthly income, which is how much money we make before taxes are taken out. And typically we have withholdings or some taxes taken out throughout the year. And that's so that we don't have a large tax bill at the end of the year. Now, when we look at things that are like, buying a house or other expenses, we always wonder, how do we incorporate that into our overall annual taxes on either A, how much money we've already paid the government, or B, do we get any additional money back? It's all driven on two simple calculations, really. You have what's called your standard deductions, and then you have your itemized deductions. And so let's just say, hypothetically, you have a member, a service member, or a family that is filing taxes, and they've made $100,000 per year. When we talk about deductions, we talk about how much then that $100,000 is going to be reduced. And I think it's a big talking point with military members in general when they're filing their taxes. How does that work? And it's all driven off of your gross monthly income. And so if your gross monthly income or your annual gross income is $100,000 and you want to deduct anything from that, it would reduce that $100,000. So instead of paying taxes on $100,000, you might be paying taxes on $80,000. That would be a deduction. So you're deducting that
Right.
gross monthly income. So I think that's a good formula to understand that it's all driven off of your income, and it's all based on how much taxes you're going to pay on your income. And so there's two buckets. There's your standard deduction, and standard deduction is an amount that the government gives you if your income is not at a certain level. You just get a standard deduction. Or if you haven't purchased a home, or you don't have any write-offs or expenses, you would get the standard deduction. And back in 2017, they updated the tax law and they changed what the standard deduction is. So for anybody that does not own a home or that's not having any expenses, their standard deduction is $13,850. It's really important because when you look at now to your first question of buying a house, how does that impact my taxes? It's important to first understand how taxes work and what that standard deduction is. So that standard deduction is simply a dollar amount that the government said, if you do not have itemized deductions and you don't have expenses and you don't own a home and you don't have any of these other things to reduce your gross annual income, we're going to give you a reduction, a standard deduction of $13,850. Okay. So when we buy a house, we're going to take our itemized deductions, which would be the mortgage interest. Okay. So we want to see, does the mortgage interest, the property taxes, medical expenses, any home expenses, does that exceed the standard deduction, right? And so what I mean by that is maybe our property taxes are $3,000. Maybe our mortgage interest is $10,000 that we've paid. And then maybe we have some medical expenses that the government did not pay that was out of pocket. Then we add that back in. So maybe there's, let's say, another, $5,000 in medical out of pocket expenses.
Okay.
Then you would add those categories up, and that comes up to $18,000, right? You have $10,000 for your mortgage interest, you have $3,000 for your property taxes, and you have $5,000 for your medical expenses that are out of pocket. Its keyword is out of pocket, not
Right.
reimbursed, right?
Right.
And so you can't double dip. And so when you add that up, it comes up to 18,000. That's greater than the $13,850 deductible. So back to our scenario, if you made $100,000, you would reduce that $100,000 in a standard deduction down to $87,000, right?
Right.
And so if you had all those other categories and you chose to itemize, you would then reduce it now $18,000 instead of the $13,850. So you will save paying income tax on on a lower amount of annual gross income when you have those itemized deductions. So buying a
Exactly.
house can be extremely advantageous because it could save you on average probably $3,000 or $4,000 of taxes that you would have paid to Uncle Sam, right? And
Right.
so when you look at adding these things up, it can be pretty impactful. So you want to make sure you first know, what are my itemized deductions? And so just in general, based on that tax law that was amended in 2017, you have really just a couple categories that you can itemize, okay? And that is your medical out-of-pocket expenses, charitable contributions,
Hmm.
mortgage interest, and property taxes. So four things that you can itemize. You add up all four of those categories. If they are greater than the standard deduction of 13,850, then that's what you would use to give yourself a tax advantage or a tax credit to reduce that gross annual income that's going to save you a lot of money out of your pocket. Does that make
Exactly.
sense?
That's awesome. Yeah. So I think a lot of military families are used to taking that standard deduction because, especially when we are younger and newer to this military life, the service member gets a W-2, and that might be your only tax document for the year. So it's a very simple, straightforward thing. You put the numbers from the W-2, you take your standard deduction, you pay your taxes, or you get your refund, and you go on your merry way. And buying a home, I think it just makes the process seem a little bit more complicated. But what you're saying is that it actually opens up these new opportunities. So suddenly people have to start thinking about these itemized deductions instead of just taking the standard deduction. A lot of times it can be very financially advantageous, but it's just a little bit more work and it's not as straightforward and intuitive. So I
Yeah,
think really the
no, I
next
was going to
question
say,
would be, like, what specifically is deductible when it
sure.
comes to home ownership?
Yeah. So when you look at that, you're going to, so now think of it this way, right? You mentioned that military families typically just straight go to the standard deduction. Just know, I think a big takeaway is, hey, I have other options to consider versus just the standard deduction, which would
Mhm.
be an itemized deduction. And so those itemized deductions are those four categories of property taxes, mortgage interest, charitable contributions, and out-of-pocket medical expenses. If those four things add up to greater than the standard deduction, then you're going to itemize versus taking that standard deduction. Now,
Okay.
something I want to point out. You just said it. Majority of your military families are going to take the standard deduction. But what I'll tell you is that's going to change going into 2024,
Okay.
especially for any military family that purchased a home over the last 24 months. And the reason is you didn't pay a lot of mortgage interest when interest rates were 2 to 3%. And so the standard deduction probably was more beneficial than the itemized deduction for a military family that purchased a home greater than 24 months ago when interest rates were really low. That's going to change. And I think this is such a great call that we're having today, because without knowing what has happened over the last 2 years with interest rates, you could be leaving some money on the table as a military family. And we know that every dollar helps when getting your finances in order and making sure that you're not overpaying the government in income tax. And this is something that you could definitely overpay the government in income taxes if you didn't check out what that itemized tally was for those four
Right.
categories. Because last 2 years, we know that mortgage rates were above 7% for a 30-year fixed. And so your interest that you're paying for the first year or 2 or 3 years on that mortgage is going to be pretty significant at a 7+ interest rate. And so
Right.
your itemized deductions are actually going to probably give you a bigger bang for your buck than the standard deduction, because interest rates were higher. So I know it sounds a little crazy. Interest rates were higher. There are some benefits to that higher rate environment that could help give you a larger refund than you probably previously expected.
That's super important to know because I think a lot of times when you keep saying that the interest from the mortgage is what's deductible, people are just paying one flat mortgage payment every month, right? We don't see always that distinction between the principal and the interest. So that interest comes out and it's a slightly different amount. And by the end of the year, I don't think the average person has a good grasp on exactly the dollar amount that they paid toward interest on their mortgage. So do you want to speak a little bit more about how we'd calculate that, or where do you find the specifically deductible interest rate for your mortgage
Yeah,
payments?
absolutely. That's such a great question. What you're going to want to do is you're going to want to go to your loan servicer. So every month, you're writing, like you said, a monthly check to that loan servicer, who is then reducing your loan balance and keeping track, managing that debt, right? Managing that mortgage loan. You're going to contact that servicer. Typically, their contact information is on their monthly payment that you're getting. A lot of times, you can just log online to some loan servicers. Big loan servicers could be Caliber Home Loans, could be Rocket, could be PennyMac, could
Mhm.
be Freedom. These are some pretty large, Mr. Cooper. These are some pretty large servicers, and you can go right online to the website. You can log into your account and you can look at your year-end tax statement. That's what you're looking for, my year-end tax statement. That year-end tax statement is going to be, it's like a 1098 or 1099. It's not a
Mhm.
1099, 1098. And it's going to
88.
give you your, yeah, you're going to give you, it's going to give you your grand total of how much interest you paid on that mortgage loan. That's number one. Number two, you're going to want to go to your county where you live, and you're going to want to go online and print your annual property tax bill. So you're going to want to print the annual property tax bill, print the annual mortgage interest statement that you get from your loan servicer, and you're going to take those two numbers and add them together, and that's your total home ownership tax deduction. And what I'm saying is, over the last 2 years, if you purchased a home, those two numbers are most likely going to be greater than the standard deduction. And that's not even including any charitable contributions or out-of-pocket medical expenses.
That's awesome, and that's super useful information. So thank you for sharing that. All right, so we covered the mortgage insurance, the fact that that's deductible. We covered property taxes, huge expense in certain areas, and again, that's usually kind of rolled into your mortgage payments, so you're not always seeing those tax payments come out every month. But trust me, you pay some property taxes every year. So, what other deductions, for example, what about people who have done home equity? Are there specific deductible things that they should know about, and where should they be getting their information?
Yeah, absolutely. So home equity is a home equity line of credit, also known as a HELOC, or it could also be a second mortgage. Okay. The difference between a home equity line of credit and a second mortgage is simply how you repay the money. they're both classified as a second mortgage. A home equity line of credit is you have a line of credit and you use what you choose and you pay back interest only on the amount of money drawn, almost like a big credit card attached to your house. And then the second mortgage is a fixed term and a fixed rate and a fixed payment that you pay back every month to buy down that loan amount. You don't get to take and pay at the same time, such as a home equity line of credit. Now, when we look at getting some tax deductions or strategies from that second mortgage, that home equity line of credit, it all depends on how you used that line of credit. If that line of credit or second mortgage was used to enhance or modify or remodel your property, it now
Mm,
qualifies for those tax benefits. And so you could take the interest paid on that second mortgage and use that to reduce your gross annual taxable income so that you're paying less income tax.
awesome. That's a good strategy too. And then one other thing that I think factors into a lot of people who own a home now, especially if you are working from home, how does that home office deduction work for homeowners right now?
Sure. So if you're a W-2, then you cannot itemize that expense of any home office or any space that you're utilizing to work remotely. That's not tax deductible if
Mm,
you're a W-2. If you're self-employed and you are filing as a self-employed taxpayer, then you can deduct a portion of your office space, supplies. You can increase your deductions when you're self-employed versus being a W-2 employee.
got it. All right. So those are all really great tax deduction benefits to know about as a homeowner. What about when you sell a home? What do the taxes look like? If I sold a home last year, we got orders, we had to move, we decided to sell. How do I need to factor that into this tax season?
Great question, especially knowing right now that home values across the country have gone up significantly over the last several years. Just over throughout COVID, we saw a 30% increase in home ownership, or not home ownership, but also home equity. And so
Okay.
when we look at selling a home now, you have what's called capital gains, right? And so if you've lived in your home for 2 years out of the last 5 years, okay, then you have, if you're filing single, you have up to $250,000 that is going to be tax free. Okay, you're
Okay.
not going to pay any capital gains on that. If you're married, jointly filing, then you're going to have up to $500,000. And so, if let's say you bought your house for 100 grand, you sold it for 200 grand, and you were single, no problem because you made $100,000. That's under the $250,000 profit that you would have made. So, whatever you bought your house for, and then whatever you sold it for, if there's a delta there between the two, if you're single, it's 250,000. If you're married, filing jointly, it's 500,000.
Okay, that's really important because I know a lot of military families are in a unique category where they own a home, they live in their home, and then they leave it for a few years. They may have renters or they may be doing something else with it while they're stationed elsewhere, and then they decide to sell. There is an important clause that's essential for our military families to know. If you've been stationed somewhere with military orders, if you've been sent overseas, the living requirement as a primary residence, I think, is modified slightly for military
That
families.
Yeah, it's a really great point to make. When you have received orders that prevent you from adhering to the standard guidelines that a civilian would have to adhere to, you have some flexibility as a military member, and you're going to want to talk to your accountant about that, and obviously making sure that your accountant is familiar with military. You also, to bring up another really important benefit, is when you are purchasing a home, you want to pay attention to your certificate of eligibility, because if you have any portion of disability, you want to look into that to see if you also get any break on your property taxes. And I got to tell you, this is so important because in today's market where home prices are on the rise, interest rates are higher than they were during the COVID era, affordability is a challenge in home ownership. And so you need to make sure you're taking advantage of all the benefits that you've earned from serving and apply those to help bridge that affordability gap, because it is a real benefit. I've seen it firsthand where a consumer military family is looking at a $400,000 house, and the monthly payment with property taxes puts them over $3,000 a month. But when you find out on their CO that they get a break and they get a reduction of 30 to 40% of their property taxes, you're talking about saving $200 to $300 per month in a mortgage payment because you have received a discount on your property taxes. Now, when we go back to filing your taxes and we do the itemized deductions, you don't get to put then the full property tax amount, right? It's kind of like your medical expenses. It's your out-of-pocket expense. So it's your out-of-pocket taxes that you would pay as far as property taxes that would be deducted from your itemized deductions. But it helps significantly in that monthly payment when you're budgeting. You could be leaving money on the table. You might be able to say, hey, I originally thought I was going to be at a $300,000 purchase price, but now because of these tax breaks that I get on my property taxes, I might be able to get that extra bedroom that I need and now go up to a 325 or 350 purchase price.
Yeah, it's an amazing benefit. I will say my husband is a veteran and has a disability rating that um, does help to factor into your property taxes in certain states. So unfortunately, every state has slightly different rules on how they treat those disability payments and the veteran status. But when you mentioned the certificate of eligibility, that is specific to the VA loan, correct?
Yes, that is specific to
Okay.
the VA loan, and that's going to help determine what your eligibility is when purchasing a home. And if you were to have already owned a home, do you currently have a VA loan outstanding? Good news is you can have multiple VA loans at one time. You don't you're not required to only have one VA loan. So if you're, moving and relocating, or you had a previous property that maybe now you're renting out, you're still able to execute a new VA loan, but all of that eligibility is determined on your certificate of eligibility.
That's awesome. All right. Well, stupendous news. Really useful information for our military families who've either bought a home or sold a home or gotten a line of credit through an equity loan this year. I hope that you will take these tax tips to heart and hopefully learn about those itemized deductions, save yourself some money, look into the benefits that you've earned for the property taxes and all of the benefits that come with military life, including the VA loan eligibility. And GoVA is here to help and support our military families in that journey, whether you're buying a home, selling a home, or trying to refinance on a home that you already own. Phil, do you want to talk about how GoVA supports our military families?
Sure. So at GoVA, we're so excited because we lead with education, and our goal is to empower military families by building financial strength. And so we've developed a platform that allows for you to go online, take self-assessments, work with technology that can help really harness today's, content that meets also all of our regulatory guidelines and agencies such as the CFPB, the FDIC. And so be able to harness that technology and really empower yourselves to learn about various financial products, whether you're creating a budget, looking to pay off your credit cards, simply just monitor your credit. All of that can be done in a safe, secure environment with no ads or clickbait with anybody trying to sell you anything. We're not a financial institution. We are simply a great resource center that is established to be able to lend an extra hand, lend some support to our military community to really educate them, level them up so that they are feeling confident in being able to move forward in today's financial landscape. And so we not only just help educate, but we also help prepare you as well. We want to make sure that if you have questions about what documents are going to be needed, what to expect throughout various financial vehicles, we're here to prepare you. We have a concierge center. If you're not too keen on technology and you want to talk to a live person, you can contact our call center. Our call center is made up of military spouses and retired veterans, and we're here to help serve you and prepare you for whatever financial vehicle it is that you're interested in. And then when you're ready to take take that step of being deployed to actually executing a financial product. We're there to hold your hand and help you get started with that process, get engaged with a financial institution. That way you have someone that's got your back. We're here to look out for you, provide the support and knowledge and information to make financial accessibility more affordable and also more comfortable and confident when you're going on that journey to build financial wealth.
Absolutely. It's a great service. And my favorite thing about the membership offering of GoVA is that it's free to service members, veterans, and military spouses. We want to put these educational tools in your hands and help to make a difference for you. So you will see a link on how to join the Edge for free. On the Edge, you'll find many financial resources. There's interactive tools, there's articles, there's courses you can take, and there's a lot of information about tax questions and tax season to help you prepare and get the information that you need. So if you found this helpful, then I certainly hope that you will follow up and read more of the tax information available on The Edge, powered by GoVA. Thanks so much, Phil. It has been a pleasure. I really appreciate all the knowledge you shared with our audience today.
Thank you. It was good being here. Take care.